Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in Andy Swan. He's a co-founder at LikeFolio. Welcome back to the show, Andy.
Thank you.
All right, in this day of tech discussions across the board, we're talking some discount retailers, Five Below. Andy, it seems like this thing can't get out of its own way. It's that bifurcation between a lot of discount retailers. You know, Dollar Tree underperformed. Dollar General did a little bit better than expected. What kind of data do you guys have out of LikeFolio on this one?
Yeah, I think Dollar Tree's earnings last week really disappointed the street. Stock was down more than 14% on that. They had a lot of trouble restocking the shelves. They had, the Family Dollar brand was struggling. And so you have to wonder, is Five Below in that same category about to see that same sort of fate? And, quite frankly, we have to say the answer to that question is no. Five Below is a better company and is performing better in every LikeFolio metric that we have. First of all, mention buzz is building, up 15% year over year and rebounding from its 2023 low. But more importantly, what you see on the screen right now is the happiness level, consumer happiness level, 77% positive, which is 13 points above its next closest peer. In other words, while everybody else in the discount retailer space is pretty much disappointing consumers, Five Below is doing a very good job of keeping those customers happy. And it's something that the company has talked about pretty regularly, is that the move to their Five Beyond brand has really helped their relationship with their customers. I think it allowed them to get out of the pricing pickle that they were in and focus more on value and kind of the fun of discovery shopping. And so the Five Beyond brand really brings that to the customer, and it's shown great results. The CEO even talks about, how much more likely someone is to come back into the store if it's a Five Beyond brand, which is now over 50% of its store count. So I think they've made a move in the right direction. They are focused on the customer experience more so than they are on strictly the pricing experience. And I think that differentiation has put them in a different category than the other discount retailers. This is kind of the category for the somewhat more affluent, discovery type of fun shopper more than it is the necessity type of shopper, which we see at the other discount retailers, which is struggling.
Andy, this company continues to amaze me. 2018, they had 650 stores. By mid-2023, 5 years later, they had over 1,367. So they doubled in 5 years. The stock went from 100 to 200 in 5 years. It doubled. And the CEO comes out and says, we're going to double again in the next 5 years. So they're going to go from 1,300 to 2,600. But here's the stat that everyone's got to listen to, Andy, and I want to hear you comment. Their initial investment to open up a store is $400,000 around it cost me. The first year open, the average earnings is $550,000. So they pay for themselves in the less than a year. They cover the cost of opening the store. How could they not keep expanding?
Yeah, a lot of times we put a lot of complexity into analyzing businesses, but when you put it that way, you can outlay $400,000 and in the next year you're going to get back $500,000 plus.
Yeah.
Let me know when to stop hitting that button.
Yes.
Yeah. And that's pretty much all it is. I think you just keep expanding until expansion stops working. By the way, at the same time, I think that they're also doing, simultaneously, concurrent in parallel with that. What they're doing is they're making each store's experience better for the customer, making those customers more likely to come back to that store, making each store more valuable. And so they're expanding the number of stores. They're making every store more valuable. They're learning from the stores that they have open so that each new store that they open up has that advantage of what they've already learned. And so I think Five Below's kind of caught that flywheel of growth that you love to see from a retailer. They've really got the model, and now it's just a matter of, executing expansion. One of the kind of places most retailers would love to be someday, and very few achieve it.
Yeah, I was kind of parlay that into the discussion about the happiness levels, because that's one of the things I look at these discount retailers. If I were to ever go into one, I haven't been into a Five Below. I got to do some recon.
It's a toy store.
Yeah.
That's what it is for young kids.
I got to do some recon here, Andy. But the happiness comparison chart that you guys have, just off the charts at this point. But now you look at some of the other names within the space, Dollar Tree, Dollar General. Dollar Tree is going to start closing stores. Is that part of the issue that, hey, Five Below is able to manage maybe that customer a little bit better because they haven't expanded their footprint as much as maybe some of the other discount retailers?
Yeah, I think so. And they lean on a different type of customer, like Kevin just alluded to, but Five Beyond, Five Below is a place you go in. If you're, a teenager, a young adult, you want a new phone charger, they're going to probably have one in there for $3.50 or $4. And then on the back wall, they're going to have a cool T-shirt that you buy for $12, and you walk out of there for $25, and you feel like you just robbed the place, and it feels really good. Whereas, Dollar Tree, Dollar General, their customer base is a lot more necessity based. They're walking in there a lot of times for the toilet paper, the home goods, the some of the grocery items that they might need. It's a totally different attitude and experience, and so when you have a different attitude and experience from the customer's point of view, it's a totally different fulfillment mechanism. And fortunately for Five Below, they kind of have that customer that they can expand upon really easily. And it seems like they're executing on that through the Five Beyond brand, which is kind of taking over the company.
Yeah, real quick here, Andy, do you guys have an earnings score going into this one? Because it's still down about 3% so far in 2024.
Yeah, we think it's about where it should be. I think you can be a little bit bullish going into this. I think you can be quite bullish if you're thinking long term. I think the downside risk is limited on this. I just don't see a huge catalyst to the upside, other than the fact I think that they'll come out and report that they're clearly outperforming peers and that they expect that to continue in 2024.
All right, great stuff. Great data. As always, Andy, have a great day.
Thank you, you too.
All right, that's Andy Swan, co-founder at LikeFolio. Before we get into this trade, Kev, guess what just went positive? NVIDIA.
NVIDIA, of course it did, because that news is significant.
Right, yeah, up 0.3% now, NVIDIA shares. Now you've got S&P 500 up about 0.25%.
And NASDAQ about to go positive.
Yeah, NASDAQ about to go to positive also. So this might be that turnaround day. We'll have to wait and see. Still got the Fed